What is up, you guys? Thanks so much for joining me today. It's your boy, the Finance Bro, and in this video, we're going to be taking a look at shares of McDonald's, where shares are trading at today. They have suffered a recent sell-off, yet this is a classic defensive name. I do believe as we head into Q3 and Q4, just due to seasonality and also the midterm elections in the US in November, this may cause volatility in markets, and having some of these defensive names will act as a cushion when those riskier assets do take a hit during market sell-offs and downturns, which is a normal function of markets long term. As always, this video is not investment or financial advice and is solely for entertainment purposes. So let's dive right in here to the past 12-month price chart of McDonald's shares. You can see that within that time frame, shares have actually underperformed their benchmark by 24.8%. When we look at year-to-date numbers, McDonald's shares are down still 9%. Compare that to the benchmark that is up almost 10%. That is a 21% negative spread, even on a year-to-date basis, of McDonald's share price performance. Comparing that to the benchmark, shares are also trading near their 52-week low. We do see a sell-off really in that late April, early May timeframe, which does coincide with the risk on appetite coming out of the initial shock of that Iranian conflict, some ceasefires and pullbacks and attacks. We did see capital flow into higher risk names, AI related names, semiconductor names, and so forth. That did take capital away from the more defensive sectors, McDonald's being one of the classic names and bigger names in that space. And due to that high selling pressure, we do see in that time frame that 50-day moving average in the green line crossover on the downside, the 200-day moving average in the orange, which does indicate a long-term technical sell signal. Yet you can see at the bottom right of that chart there a significant boost in share price performance over the past couple of weeks on high volume, I will say at that. Not only did that allow the share price to cross over the 50-day moving average on that long-term chart that we're looking at, but when we look at shorter-term price charts, there is actually a technical buy signal flashing for McDonald's shares with that 50-day moving average in the short run. Looking at 1 month or less in share price performance and our technicals, that 50-day moving average did cross the 200-day moving average on the upside, which does indicate that technical short-term buy signal. Few items I want to point our attention to is that earnings per share growth, really from 25 to 27. You're seeing earnings per share grow almost 17%, $2 per share. That does coincide with McDonald's target to have 50,000 locations open by the end of 2027 globally. And that international segment, which we'll touch on later on in the video, is going to be a key driver of revenue, margins, and earnings per share growth. McDonald's does pay a dividend of 2.7%, which does coincide to a $7.44 annualized dividend. Sales growth of 6.8% over the past year. Again, this is a very defensive, mature company that's been around for many decades, survived many business cycles, recessions, and so forth. We're not going to be looking at the NVIDIA sales growth or other AI and chip-related names. This is a defensive name to act as a barbell in our portfolios. High single-digit, low double-digit sales growth is a normality in these defensive sectors. Yet when we look at the profitability metrics, we're seeing very healthy margins, gross margins at 57.3%. You look at that 10-year bar chart there, we're seeing gross margins trend in the right direction, and we're not seeing a big compression from gross margins to net margins. That gross margin at 57.3% to net margins of 31.6% is actually better than some of these technology companies that we looked at in previous videos that I do encourage you guys to go take a look at after the end of this video. Yet those margins are an overhang on the stock currently, with transportation costs rising, shipping costs rising, fuel costs rising, beef and other input costs that go into running a McDonald's restaurant all rising, which is causing worry in the market that margins may compress. Right now, we're not seeing that, but in the future and in coming quarters and coming reports, we may see that. So investors should keep an eye on margin compressions going forward. But when we look at valuation metrics, a forward PE of 20.5, a trailing PE of 22.9, even a price of sales of 7.2 is not an overvaluation. In some cases, a deep value valuation for a company that has proven the test of time, is still growing, and still has healthy margins, and acts as a defensive buoy in a sense to our portfolios. There are 28 analysts who have target prices on McDonald's shares with an average price target of $327.07, which does imply a 17.55% upside from where shares traded on market close on July 8th, 2026. The most bearish analyst having a $250 price target, implying shares declining a little bit over 10%, with the biggest bull having a price target on McDonald's shares of $375 by year end, which does imply a 34.77% upside. We can see in that chart there that solid blue line is McDonald's share price, that dotted line is the analyst target prices. We have never seen such a discrepancy between institutional money managers' true value of McDonald's shares and the underlying business compared to where the market is pricing shares today. I do believe there will be a catch-up trade. You also see those green bars being extended at their highest level over the past year, and that red bar being compressed, having only 1 to 2 sell ratings on the name currently of those 28 analysts who cover McDonald's shares. So that risk reward, I do believe, is warranted, and there should be a compression of analyst target prices and McDonald's market price. And that compression, I do believe, is going to be from share price appreciation, not from the analysts cutting their price targets. And this is a good graph here to look at. This is the 5-year valuation of McDonald's shares. Look at that forward PE, currently at that 20.5, like I mentioned earlier, below the 5-year average, which is 23.7. The 5-year low on a forward PE of McDonald's shares is 19.1. We are not too far off from that 5-year low, and also trading near its 10-year low as well. You're looking at very cheap valuations for a solid business, which can act as a defense in market downturns. And we see those profitability ratios all trending in the right direction over the past 5 and 10 years. Again, gross margins to net margins not compressing as much as other businesses. This can be an overhang in the stock that we'll touch on later on in the video. There is a return on equity reporting issue, but when we look at the return on total capital and return on invested capital, return on total capital as of year end 2025 was 24.5%, return on invested capital at 17.2%. Mind you that McDonald's is also a real estate company in a sense. They own the land that the franchisees rent from corporate, and they have the appreciation of the value of that land as well. With a lot of the investments that McDonald's has made in improving technology, having more self-serve centers in a lot of their locations, improving their drive-through operations, which allow them to serve more customers, has transpired into that operational efficiency metrics that we like to see in revenue and net income per employee, continuing to rise in a steady pace over the past 5 and 10 years. And we should continue to see that as McDonald's is investing heavily in these self-serve machines and other operational efficiencies in their drive-thrus and in-store dining to improve revenue by serving more customers, while also ensuring that their margins continue to expand long-term as they have in previous years. And when we look at these financial statements, now on a 10-year compounded annual growth rate, some of these numbers are affected by COVID and coming out of COVID, whether that's looking at the restaurants being shut down or consumer habits transitioning to healthier options. But the 5-year compounded annual growth rate truly reflects management's goals and intentions and new strategy that they have taken really since the end of 2022. And you see those healthy numbers on a 5-year compounded annual growth rate better than the 10-year compounded annual growth rate. You're looking at operating income on a 5-year compounded annual growth rate of 11.6%. We're seeing earnings per share on a diluted basis on a 5-year CAGR of 13.6%, on a recurring basis of 15% on earnings per share on a 5-year CAGR, and even EBITDA at 10.3% on a 5-year CAGR. These are very healthy numbers for a mature company. Again, let's not get numb to the numbers we see in a lot of these technology and AI related companies. This is a company that will give you steady returns, give you that long-term growth in underlying business and shares as well, and will act as that cushion when we do have market volatility. Again, market volatility happens on a 5% decline, happens on average 3 times a year. 10% declines on average do occur once or twice a year, especially in recent cases with a lot of algorithmic and computerized trading where decisions and sell-offs happen in seconds. We do see a lot more volatility in markets, and companies like McDonald's offer that cushion to volatility over the long term. And we ask ourselves, with all that cash that McDonald's has produced, well, what are they doing with that cash? A lot of shareholder friendly materials, I will say, they're not keeping as much cash and short term investments on their balance sheet as of 2025 year end. As of their most recent quarterly reports, that has continued to trend in the same direction of keeping low cash and short term investments on the balance sheet. They are paying down debt. Last year was their highest paydown of debt. I will say also higher interest debt that they issued. They have steadily increased their dividend, both on the 5-year that you see in front of you, also on the 10, 15, and 20-year basis as well, which is why you see that 2.7% dividend, and you see that dividend increase year over year. And on top of it all, investors are receiving an almost 3% dividend every year that grows. Management is also repurchasing shares, which acts as a fictitious dividend, like I say in previous videos, through capital appreciation and capital gains. I think now with the shares really declining over the past few months, management should look into purchasing a lot of the shares and taking them off the market, especially at such a low price. This will improve their balance sheet as well. And that international growth segment is really what's driving the next phase of McDonald's. Domestically, they have faced some challenges, whether that's changing consumer habits, franchisee vulnerabilities, macro issues, and so forth that I'll touch on in the next snippet. But that international growth segment not only has expanded margins for the company, but should expand revenues and profitability long term. A lot of those 50,000 restaurants that I mentioned earlier that McDonald's wants to have open by end of 2027 will be in international and emerging markets, which is what we want to see, considering domestically the US makes up 40% of the revenue as of year end. I will say, as of most recent quarterly reports, these numbers are very similar. Europe is growing, and also the Asian regions as well, with the US staying relatively stagnant as it has been for the past really 2 to 3 years. You see a decline there of 1.8% year over year. Canada and Australia as well seeing those same declines. Mind you, Australian, American, and Canadian cultures are very similar. Dietary habits are very similar. So if one region is focusing on healthier eating habits, other regions will follow suit, and McDonald's will see those revenues decline in those regions just due to those changing consumer habits. So now that we looked at a few of those fundamental and technical metrics, I do think it's important for us to look at a few bull and bear points of McDonald's. We touched on a lot of those strong financials, the healthy balance sheet, and also, like I mentioned at the start of the video, short-term technicals are actually indicating a positive buy signal on shares, and you also see higher volume as of late on the buy side, which means institutional money is starting to back the name. Retail investors are starting to dip their toe in the water as well, so we should continue to see upward pressure on McDonald's shares. The expansion strategy, like I said, 50,000 locations by the end of 2027, I believe is doable, and having those international markets as well is, as an investor, something that we want to see, as those are very high margin areas that McDonald's is going in, and if they're able to establish better partnerships with local farmers and producers, they may be able to get better pricing, which means they may be able to expand margins as well. Investors, we'd love to see expanding margins. And McDonald's, like I've been saying, is viewed as the highest quality defensive business with stable cash flows. Its model, which is predominantly franchised, provides a reliable stream of royalty and rent income that is generally more resilient than company operated models. And the company's partnership with the 2026 FIFA World Cup and relaunch of the McValue platform are designed to drive traffic and capitalize on the strong expected performance in the second half of this year. Seeing these McDonald's commercials and being a customer of McDonald's, heck, some of you might be eating a McDonald's meal right now, they are really emphasizing their World Cup partnership, which should drive revenue, and also that McValue menu with a lot of micro and macro economic headwinds, but a more penny pinched consumer. That McValue menu should continue to drive revenue and expand margins as well in the coming quarters. Now, while revenue is up and gross margins have been expanding, as of Q1 2026, gross margins actually fell to 56%. That's the lowest in 8 quarters. This has largely been attributed to commodity and wage inflation impacting costs. Like I said, beef prices rising, transportation costs rising, but also in certain areas, say in Canada, where the minimum wage has been constantly being increased every couple of years, labor costs are now also making up a significant portion of costs, which does in turn lead to compressed margins. Hopefully, the commodity side can provide some relief for McDonald's to allow them to have that margin expansion that they've been executing on for the past couple of years. Like we saw in the previous snippet, the US market has faced soft trends, not only from changing consumer habits, but a lot of McDonald's customers have raised concerns regarding a lack of menu innovation, which has caused difficulty in driving consumer traffic into the stores. There is a fear that if the US same store sales remain negative, the unit growth story may not be enough to compensate for the brand stagnation. And as franchise royalties make up a significant portion of McDonald's revenue, the company franchisees are facing economic headwinds that stress small business profitability, that negatively impact royalty incomes, especially in these developed markets that McDonald's is expanding in. They have relatively new partnerships, even though they are a well known brand. These new partnerships come at a higher cost, and due to these higher input costs and lower profitability for franchisees, the franchisees are struggling, and that in turn leads to, like I said, lower royalty revenue for the company as a whole, which as shareholders we get affected by as well. But hey, let's see how this plays out in the market. Only time will tell, but I do thank you guys for making it to the end of the video. And please do hit that like and subscribe button and stay tuned for the next video.